We got a pretty decent crowd on here, guys, and it is 10:05. So let's gear this thing up and let's get going. So we're going to have some fun. We're going to talk about subject to transactions, what they are, how they work, some items about today's market and where we're going with that. So because of our time constraints, let's jump right in and get this puppy going quickly, guys. So first off, owner financing, what is it? Because it's really a pretty simple strategy. It's where the seller is our financing source. They become our bank. And there's two types of owner financing out there in the marketplace. And of course, one is where there is no underlying debt. We would call that straight direct owner financing. And then of course, the other is where there is underlying debt. And in that case, we're able to acquire that home either through a wraparound mortgage, which can take on a couple of different scenarios, which can be identical to the existing mortgage. We call that a mirror wrap, or on different terms. And then, of course, we can buy it indirectly through what we call the subject to transaction. So exactly what the heck is sub to? Because so often people don't understand what this really means. So let's just kind of walk through briefly what subject to means. And so again, this is where we, the purchaser, the investor who's buying the property, is agreeing, of course, to buy the home. And what they're doing is they are agreeing to make the seller's payments on their mortgage. What I think is very important as part of the transaction is where they are providing the seller security for the transaction. This is through a deed of trust or other security instrument in order to protect the seller, which is extremely important in the subject to industry. I see too many investors who don't do that, and all they're doing is opening up a potential can of worms and for a possible lawsuit in the event of any type of a default. Now, when you do a sub-to transaction, guys, this is a transaction that is recognizable between the buyer and the seller. And what is so important again is this is not an assumption transaction. An assumption means you go to the bank, you provide them all your financial information, and you actually qualify for the loan, and the bank substitutes you for the original borrower. So on a sub-to transaction, there is no bank qualifying, which is kind of one of the cool things of sub-to and how it works. It's also why we prefer subject to over the wraparound mortgage when buying homes. So again, when you do a subject to transaction, it allows the buyer to take advantage of course, lower interest rates. And I need to add some people on here real quick. Forgive me. Who do I need to add?
Minimum wages such as chair. Remember
Got
to do it in.
So again, I'm sitting here trying to do three things at once, guys, and the one thing I am weak on is technology. One day I'm gonna learn this stuff
No,
from the cheap seats behind me. So again, why do we go out and buy a property subject to? First and foremost, of course, it's lower interest rates today. And this became so popular because of what was going on for the last 10 years in our mortgage marketplace with all these low interest rates that are out there. We now have this advantage of buying homes subject to the existing debt. And it allows us to take advantage of years of payments being paid down on a loan, hopefully. And again, in this scenario, this is where the buyer pays the mortgage company direct. Although a buyer, the investor, we could pay a loan servicing company if we wanted to. We try to avoid that additional cost and expense. The big issue, though, is the due on sale issues apply. And we're going to address due on sale later on in the program. As we go through, the sub-to transactions, disclosures, I think, are required and are necessary. Some may be mandatory, some may not. But to me, the two biggest issues when buying a home subject to is the fact that it's disclosing to the seller due on sale, because trust me, guys, they have no idea what that is, what it means, or that it's even in their mortgage. And, the seller has continuing liability on the mortgage until such time as it is paid off. And the one thing we don't want to do is tell them we're going to pay that mortgage off at some prescribed time. I've seen some investors try to do that in order to entice the seller to deal. And of course, they have no intent to do that. So we don't want to do that. And the loan's going to be paid off whenever the loan is paid off. Now, Texas is one of the more complicated states in which to navigate owner finance transactions of any type. So you want to make certain you understand what the property code says here in Texas, at least, because we have what is called the underlying lien disclosure notice, and we have the insurance disclosure notice, both which must be given from a seller to a buyer in Spanish and English, as well as any other language that the transaction is negotiated in. Now, to this date, we've done nothing other than English, although we do a huge amount with the Hispanic population. And I don't want to negotiate these deals in Vietnamese or Chinese or whatever. I have no idea how to even draft those disclosures. Again, when we're buying a home subject to, the seller and or the buyer could get title insurance if they're so inclined to get it. It is available. One of the most important things in the sub-to, business is understanding how to navigate insurance, because when you change an insurance policy, this is what puts a lender on notice that there has possibly been a change of ownership. And keep in mind, as the investor, we are the buyer, and it is our decision what we want to do with insurance, who we go through, who we use, things of that nature. But I do like to get new insurance whenever possible. It's typically a standard 1-year prepaid policy, because that's ordinary for the mortgage company. And we want to keep this as ordinary as possible. Now, as we go through this, with insurance, I'm not going to get off into the weeds here on insurance too much, but we want to make sure that the original borrower, that seller, as well as us, the investor, are co-insureds, or one of us is the additional insured on that policy. Because if that borrower is not listed as an original insured, when the lender gets that policy, they will kick it out. And then finally, as the buyer, I prefer to pay the lender direct, almost always. Could we utilize a third-party loan servicing company for a subject to deal? We could. And if it makes the seller happy, great. I think it's unnecessary, because a seller always has the simple ability to go online to the mortgage company and verify payments are being paid in a timely fashion. And again, as I said, as the investor, I like to pay the lender direct and control that. Now, I think at the very bottom of the screen there, you see that we want to remember that the average person in the marketplace, guys, that's 99% of the market, they have got no clue what subject to means, what it is, how it works. And when you start to bring this up to them, as I say here, you'll get all type of looks you can imagine, because they've never heard it before. We in the investment industry talk about it all the time, but in the real world, not so much. So I'm going to go off script just for a moment, y'all, and just want to talk about sub-to and a little bit of the history of sub-to, because this is something that's fairly new to the investment community. It came on the scene somewhere in 2015, maybe 2016, but I go back to the late 1970s through the 1980s even. And back then we had what was called FHA, non-qualifying assumable loans. You could just sign a document, step in, take the loan. FHA, VA, they did not care at all. They were in first lien position. They were happy. And what the heck has changed over the years, I really don't know. But it has a little bit. Throughout the 1990s, we actually called the sub two world silent assumptions because it was a transaction that was valid between the seller and the buyer, but it was silent as to the lender. So we called it a silent assumption along the way. But in the 1990s, what was interesting was you didn't do a lot of that business unless it was an FHA non-qual because the mortgage rates from the 70s through the 80s were so high, the banking rates were much lower. So you would normally go to a bank and pay cash for a transaction and get a bank loan at a much lower interest rate than you would through a subject to transaction. And then as you fast forward to 2008, 2009, when that wonderful real estate crash hit, the whole world got turned upside down on its ears. And this is where things became more relevant because interest rates started dropping, but also nobody for a period of time after the crash could get a loan. We investors couldn't borrow money. Homeowners really had a hard time getting loans. It took a long time for that to open back up again. And so the sub two world started to come into existence at that point in time. And it was just an awesome mechanism. And then somewhere, as I said, somewhere around 2015, 2016, as we were doing silent assumptions, as we said at those times, we all knew we were buying the property subject to the existing debt. It just started to form and became called subject to instead of silent assumption. So that's just what I've seen in the marketplace out there regarding these things. So when you look at doing a subject to deal, you got to go, would somebody really allow me to take over their loan like this and buy their home? You know, this is their largest asset that the great majority of people ever have is their home. Not only that, but their other asset they have is this their credit that is involved in this. And it's important for us when we buy a home to make our payments timely because it's about the seller's credit and we want to protect them all we can. And all I can tell you, if you are not already in this industry, is that sellers do this absolutely every day of the week. And there are so many issues out there that that sellers need help with. It is great. But keep in mind one thing, because I'm seeing a lot of this today in today's marketplace, is that just because a seller says yes as to a sub two deal doesn't make it a deal. And I'll try to talk about that a little bit as we get a chance to go along here. And I'm trying to admit one more person there. I got him in. So take a moment and just think to yourself, why would a seller let us do it? And again, it's about market dynamics. It's about people also, because sellers could be in trouble due to foreclosure. Guys, there's a ton of forbearance out there. There is a ton of what we call HUD, partial claim deeds of trust, which is where, you know, millions of homeowners did loan modifications and the arrears get put into a second or a third lien mortgage called a HUD, partial claim deed of trust. Maybe sellers can't sell homes because of the property condition. They could have lien issues such as judgment liens, IRS liens, child support liens that just prevent them from selling it. And what's important is learning how to navigate liens, and we'll touch base briefly on that. Because of all of these things, a retail sale, meaning an all cash sale, is usually not available, whether it's to a retail home buyer or even to a cash investor at a discount. The numbers just don't work. None of these sellers really want to be a landlord. And although short sales could be available, those are becoming a thing of the past a little bit. They may come back on board, I don't know, but they're getting harder and harder to do and fewer in between. And I think what I would tell the investor out there, and even the novice investor, is when you're able to properly explain to a seller what their options are and what their situation is, almost every time they're going to go with you on the seller financing and the subject to type transactions because the bottom line is most of the time is they have no options at all. And so you become their saving grace along the way. So another thing that pops up, and you'll see this a lot of times with realtors and with sellers, we want to make sure we grasp this, is the legality of it. I still find it funny. I even hear it today that subject to type transactions are illegal. And okay, it is not illegal at all. A subject to deal is not illegal. A wraparound mortgage is not illegal, period. Yeah, we have a contractual issue under the due on sale clause. And one of the things a lawyer out of Colorado coined years ago is that there is no due on sale jail. So I like to use that little phrase when talking to sellers sometimes. And you want to make sure you know what your state property code says. And again, here in Texas, a little more problematic. But if you look at our Texas contracts, and we have a promulgated contract in Texas, it actually has provisions for owner financing in the contract. Our property code provides that if you're going to buy a home subject to the existing debt or a wraparound where you're leaving an existing mortgage in place, you must follow certain rules, the underlying lien disclosure notice, the insurance disclosure notice, those kind of things. And this comes out also in a recent bill called Senate Bill 43 that came down in January of 2022. Now, due on sale, this is something you have to have a grasp of and be able to explain it properly, quickly, and what it is. So guys, due on sale simply means that when you sell a home and there's an existing mortgage, the seller is supposed to pay off their mortgage. Easy. Well, over years, this has changed where banks, because of control issues, I want to say things, if you sell a home with an executory contract, that could be a contract for deed or an agreement for sale or a land contract based upon what state you might be in, they can call the loan due. If, pardon me 1 minute, guys, let me admit these people in. Which I think I have done, good. If you execute a something like a trust and you assign the beneficiary interest, they can call the loan due. I've seen it where if you execute a lease for longer than 3 years, it could be a violation of due on sale. It's all about control by the banks. That's all it is. But due on sale is not illegal. As I've said, it's just a breach of a contractual provision. And it is simply understanding it, because the scary part is the lender could ask their borrower, the seller, to pay off the loan. But what does a lender really want? And I ask these simple questions to every seller, even every buyer out there. And when you ask those questions, what does the lender want? The universal answer is they want their payments. And do they really want to own the house? Heck no. Lenders are in the lending business. They are not in the real estate business. I find it interesting also, I've heard this come up recently about if interest rates escalate and go up as they had in the last 6 months or a year, lenders might want to foreclose on the property so they can put their money out at a higher interest rate. Guys, I personally believe that could not be further from the truth. That is an investor mentality. That is not a lender mentality. Lenders close these deals. They package them up into billion-dollar packages, sell them off to Wall Street in tranches out there. And the investors, once they have invested their money, they're just looking for that return on their investment. Those guys don't want to deal with the headaches, the issues, or anything else. They just want their money. And the loan servicers, they just want their fees for collecting. So hearing people say that lenders are going to foreclose because of higher interest rates, I have not found to be true. And I go back to the 80s when mortgage rates here in the United States were anywhere from 14 to as high, I saw as high as one point, it's 18%, maybe even higher. And they weren't doing it then. So why in the world would they do it now? So I just don't think that's an issue. I've also heard people say you got to be licensed to seller financing. And of course, there could be some rules and regulations in a particular state for that. Here in Texas, we don't have that. The only issue in Texas that we have now, because of this Senate Bill 43 that came down, is that if you do more than 3 wraparound deals in a 12-month period, you've got to be a licensed RMLO and licensed with the state. Now, what's funny is if you ever read this bill here in Texas, it describes a subject to transaction as a wraparound transaction. I don't think they intended to do that, but it's something to always keep in the back of your mind if you're doing business in Texas. Also, as you get into this, you learn some of the compliance issues, but one of those is the SAFE Act, which is about processing and providing RESPA disclosures to a owner occupant. But an owner to owner transaction, they're exempt. So if you're an investor buying from an owner, maybe you're assigning a contract to another homeowner, that deal is technically exempt from most property code issues, SAFE Act, this thing called the Dodd-Frank Act as well. Now, where it does come into play is if we're a non-owner occupant, the investor, to an owner, now there's some different issues that we got to think about. And again, mostly in Texas, and I don't see these issues in other states, thank goodness, at this point in time. But if you're doing business in any state, find a knowledgeable real estate attorney that you can ask questions to make sure there's not any rules that you need to know about in your state. Another thing as an investor we need to know is what is a commercial transaction and what is a consumer transaction. So of course, a commercial deal is a business purpose loan. It is a non-owner occupied type loan. And the good part is there's almost no regulation for those. It's all contract law. But if you're selling a home to a consumer who's going to live in that home as their homestead, this is where we get into a lot of regulation. The SAFE Act comes into play, Dodd-Frank, RESPA, which is the Real Estate Settlement Procedures Act. In Texas, our Texas Property Code and Finance Code come into play. You've got to know what those are out there. And it's important for us just to follow these and to start learning, at least getting a modicum of knowledge of pardon me again, I'm trying to get this person clicked in here. There we go. So anyway, taking time and starting to learn the outlying issues of the SAFE Act, Dodd-Frank, and RESPA, I think is important. So when we are going to buy a home, and whether it's buying subject to or whatever, I always try to teach investors, you need to make certain you know what your back end strategy is going to be before you buy the property, guys. So many investors, their thought process ends right here at the end of their nose. And they're just happy to be buying the house. I get it, but you got to if you're going to run a business and do this, have an idea of what are you going to do. So are you buying that house to fix and flip? Are you going to buy it to lease it? That could be a long-term lease, a mid-term lease, a short-term lease, such as an Airbnb. Awesome. Or are you going to do an owner finance sale where you would do a wraparound mortgage in that scenario? Are you going to assign your contract to another investor or homeowner? Now, it's important to think about that because there's a time and place to use a land trust. And land trusts came onto the scene several years ago. And the one thing here about that is anonymity. I will tell you all that that's one of the things that I rarely ever think about, or I've never thought about it in that instance. So just don't worry about it. But I've got no objection to investors using a land trust. And what I try to get them to think about is if you're going to buy a property and you're going to either hold it as a fix and flip, it's going to be a rental property of some type, or you're going to live in it, I have no objection to buying that property subject to into a land trust. It's not a bad strategy. But if you are going to do a wraparound mortgage to a back-end home buyer, I think it's self-defeating at that time because we'll use that land trust in the event of a due on sale coming up in that instance. So understand these kind of things. It'll help you be more effective in how you run your business. So I go back to 2009 and 2010 when we were buying a lot of homes subject to the existing debt. It was an awesome time because we were able to buy homes that were in mint condition, taking over very good interest rate loans. We were able to, in most cases, sell these homes with a wraparound mortgage where we could get a down payment that would really go into our pocket because the loans were current from the existing seller. They had no repairs, and we got cash in our pocket from the down payment. We got equity, and we got immediate cash flow. It was an awesome time, but it was just part of the market dynamics. But things do change, and in today's market, pretty much what you're going to find is that most sellers are behind in payments. Not all, but most seem to be. And there is money you need to reinstate the loan. Most of these houses are going to need repairs of some type. And you're going to need money for interest carry. And so you've got to be thinking about that. And is this going to be your cash or third-party cash of some type? You also have to understand liens. And there are various liens that can affect mortgage or properties out there. And of course, the first and obvious one is your purchase money mortgage. It could be a reverse mortgage, a refinance, a first and second lien. It could be a HUD, partial claim deed of trust, as we talked about earlier. There are down payment liens out there, judgment liens, child support liens, restitution liens, and of course, this new thing coming online, which are these solar power UCC liens that really only attach to the solar panels and not to the real property. But title companies in today's world just want those removed because these solar panel companies are filing these UCC liens in deed record, which is really inappropriate in what they're doing. So again, when we're buying a home sub 2, guys, what we want to think about, and I'm just kind of scrolling through it for a minute, it's truly a different way of thinking about going in and making a cash, purchase for the property. Most investors are taught to buy equity. When buying for cash, the rule of thumb historically has been buying at about 70% of the after repaired value of the property. And so you take the ARV times 70% minus the cost of repairs. That has been the traditional equity type model out there. But again, as our marketplaces change, everything else changes too. Today, when you buy a property subject to, sometimes we're able to take advantage of some attractive equity, or we can create some attractive equity, which is kind of nice out there in the marketplace. It's also about creating cash flow. And in my world, guys, cash flow is king. You can't spend equity, but you can spend cash flow. And that's what drives your business as we move forward. I just want to take a minute and go through some examples. And guys, I will be looking forward to answering questions for you too. That's kind of the fun part of doing these little short seminars like this, is helping investors better understand this out there. So let's just talk about a dealer for an example. This is a property that my partner and I actually purchased here in the Dallas-Fort Worth area. And at the time we did this has probably been 5 years ago now. The actual value of this home was $210,000 on an after repaired value basis. The problem is that it needed 25,000 repairs when we got there to look at it. Now, the client had a $123,000 first lien mortgage. Before we went out, we had already found a $36,000 second lien, and this was a HUD, partial claim deed of trust, where this person had gone through a loan modification. And guys, that $36,000 represented 3 years of non-payments. So that was quite a bit. Now, when we got there and on the phone, we'd already been asking the right questions. We knew she was behind again, about $15,000. So this person was 4 years behind in payments. So we get there, and it's a good house in a decent neighborhood. We would call it a B neighborhood, more or less. And
Mm.
we got a chance to do our inspection, and this house needed paint, flooring, kitchen countertops, appliances, some updates and whatnot. It wasn't a huge rehab, but it was 25,000. And you look at this, and when you add up the uh, the first lien mortgage, the second lien mortgage, the 25,000 in repairs, and the new arrears that she's behind. And I'm doing the quick math to make sure I'm right on my payments, but that brings us in almost at $200,000 on a house that's worth 210,000. Now, guys, a cash investor would come in, and at this time of our marketplace, they might have offered 160, maybe 165, less the repairs. So somewhere around a 135 to 140 offer. Well, the only problem is that's your cash offer, but her payoff is $175,000. So there's no way she could accept an investor cash offer. What I found interesting about this one deal is that when we got there, she didn't even know she had a second lien mortgage of $36,000. Reason for that is these HUD partial claims have zero interest and zero payments. So it's the out of sight, out of mind syndrome. And she just forgot about it, just had no idea that that was there. But of course, we already knew about it. She also, on our first meeting, failed to tell us she had signed a contract with a realtor where they were trying to sell a home. But this realtor, this is a little disconcerting, the house would not pass appraisal standards. So why are they trying to sell the house even retail? And we're about 3 weeks away from foreclosure on this home. And so we went in and we actually bought this home, and it required us to come up with not only $40,000 to pay the 25,000 in rehab and the 15,000 of arrears. We paid her a couple of $1,000 for walk-away cash so she could actually move and get into an apartment where she needed to be. But we also needed some interest carry along the way. So we borrowed about, I believe, 45,000 or so in this instance from one of our private lenders on the property. We did the rehab. And in this instance, because we're out of pocket $45,000, instead of renting the home, we went out and we did an owner finance on the house. We sold this home at this time in about 3 to 4 weeks. Just after the repairs took a couple of weeks to get done. So it took us about a total of 6 weeks to get the house repaired and sold. We sold it for $240,000, not $210,000. We got a $24,000 down payment, and we got a 9% interest rate from our borrower. So after we paid some real estate commissions, we took the balance of that, we applied it to our private lender. So now we owed our private lender about, I think, $25,000 was that number that we owed them. But we're generating at this time $1,000 a month of positive cash flow between what our borrower is paying us and what we're paying the mortgage company. So keep in mind, with this example, we're only making a mortgage payment on that $123,000. There's no interest payments on that $36,000. But I'm also having to make payments to my private lender. But after paying the first lien mortgage, this one transaction generated $1,000 a month in positive cash flow. Now, I didn't put that money in my pocket. What I did was I took that $1,000 and I applied all of it to my private lender, meaning I made zero profit during that time frame. So we had other income sources. I didn't have to live on this money. So it took me about 25 months to pay off my private lender. And once they were paid off, at that time, we had created a legitimate $65,000 of equity out of a house that had zero equity. And this is something you want to get your head around, and how you create that. And because on day one, there was zero. But as soon as you paid off that rehab loan and the arrears loan, et cetera, now you have this built-in equity. So if the borrower ever sold the home, refinanced, whatever it might be, you would make this profit. And in addition, we're now making $1,000 a month going forward for as long as this deal may last out there. In this instance, about 4 years after buying the home, our borrower did refinance it. So we made not only 24,000 of positive cash flow about, we made another 65,000 in the equity. So this deal was a home run, making almost $100,000 on this one transaction. And learning how to think through a deal, how to play it, is what this business is all about. It's learning how to structure a deal properly. Another deal down here was where the ARV was 175,000. Very low rehab, only $5,000. And at this time, thank goodness, they were only about $5,000 behind in payments. The problem is the mortgage was $175,000. Don't remember the exact situation there, but you look at that, and most investors go, why in the world am I going to pay 102 or 3%, maybe 105% for a house? Nobody wants to do that. But in the sub 2 world, you can. Now, again, in this instance, we did go in and buy this home. We needed $10,000 to get the home income repaired, to get the payments brought current. Needed a little bit of cash flow. And this one deal, because we did sell it with owner financing, as you can tell, for right at $200,000. And we got $20,000 down as a down payment. Paid some commissions, but that net down payment in that instance reimbursed us not just the $10,000 we were out of pocket for the back payments and the repairs, as well as for our interest carry. This deal happened very quickly again, probably within 4 to 5 weeks. And so after that, we actually had a little bit of cash, not much, that we put in our pocket. And now we're making $800 a month cash flow. And of course, you ask the question, who wants this? And we all want this, just because it's an awesome way of learning the business. Another deal just to talk about, just to give you guys a good example of how these deals look, is a deal here on Eagle Rest, which is up in the Fort Worth area. And this is a home that when we bought it several years ago, had a $400,000 value. It had a very low first lien mortgage, though, of $145,000. And believe it or not, the borrower was $100,000 behind in payments. Now, the good part is this house was in excellent condition, needed zero work done to it. They were over 6 years behind in payments. And you kind of go, that was me. I'd been kicked out of my house years ago. Don't know what happened, but it was there. Of course, the problem with this was you needed $100,000 to close this deal. You got to be able to find that in some format, either through your own capital or private capital. Now, in this case, we leased it back to the actual resident, which is something I don't do very often, but in this case, I did. It was leased back at $3,500 a month. They didn't want to move, and it generated $1,850 a month in positive cash flow. So yeah, I had to go borrow $100,000. I had no downtime at all in this scenario. And it allowed me to pay off our private lender in 68 months, and we're still going through that right now. Now, my tenant defaults, I can sell this home today for $425,000. I could probably get $40,000 down payment if I want to do an owner finance. I could sell it retail and get about a $28,000 net down payment, which I could apply to my private loan again. And in a total of 5 years, guys, 5.5 years or so, I'm generating a legitimate $250,000 of equity and almost $2,000 a month cash flow on a transaction like this. Learning how to play this game, how to look at things differently, give you a lot of options. Now, again, This transaction is not an instant gratification deal, which is what so many investors look for and what so many investors want. They want money today. I get it. That's why you have the wholesale world and the fix and flip world, but even fix and flip isn't money a day because the average time for a fix and flip is about 7 months before you actually realize any money from that deal. And I always tell investors sometimes, make sure you have primary sources of income until you get up to a certain level where you are comfortable enough to quit your day job and you can replace it with the income you're generating from these types of transactions. So just to wrap up here, and I want to take any questions y'all have, quick step-by-step processes is obviously we want to meet our seller, determine what their situation is, have empathy in what's going on. We want to get the most current mortgage statement, any mortgage docs, legal docs, disclosures, copy of their insurance. And remember, if your seller is in a pre-foreclosure, you may need to go back several months to get a better mortgage statement because mortgage companies stop sending traditional mortgage statements and they send a foreclosure mortgage statement, which is very different. And you want to know what the actual terms are along the way. Make sure you've talked, you and your seller, if they are behind in payments, get on the phone with the lender, the attorney who's handling the foreclosure, get that reinstatement ordered immediately. Sign your contract. Here I called it a TREC, which is the Texas real estate contract. This is I'm being a little self-serving here. Contact us to prepare your disclosure package between your seller and yourself. Go back to the property, sign it again, meet with your seller. And guys, too many gurus out there tell you to do a one and done scenario, meet with the seller, get it done. I don't like that philosophy. I like to go back to the property, meet with the seller, re-explain things, make sure we're all on the same page. It's what prevents problems. It gives me a chance to look at the property one more time to make sure my repair estimates were accurate. Did I miss anything? And that second time to look is so important. Get that contractor disclosures to your closing agent, get earnest money paid, get your insurance in place. And guys, unless foreclosure is happening in a few days, I like to have a minimum of 8. I really like to have about 2 weeks between the time we go to contract and closing. And this is to allow the seller time to review the paperwork, go out and consult with an attorney, a realtor, their financing person, whatever it might be if they wish to do so. And it's giving them an opportunity and not rushing through a deal. It's a smart way of doing business. Now, here in Texas, a buyer has the right to terminate these transactions for any reason within 7 days. It's not an option period. That's what our Texas underlying lien disclosure notice talks about. What you'll also find is most sellers rarely seek an attorney, a realtor, or anybody, it seems like. They just simply trust you. They're in a bad situation. They need to get out and they'll roll from there. But if they do, be prepared to answer whoever's questions appropriately. It'll make your deal go smoother. Take time and get your closing scheduled and close. Make sure at that closing table, you know what it is you need to be executing, your settlement statement, your deed, giving the seller back the deed of trust. Make sure that that loan is getting reinstated with your mortgage company. Remember, it's going to take about 30 days if there is a pre-foreclosure mechanism for the mortgage company to reopen your online portal. And I prefer doing everything with mortgage companies online, not through a power of attorney, not through an authorization form, but online. I use the POAs and whatnot to hold them back in that scenario. Now, from there, once you've got all this done, you're ready to go out and start making money, whether you're going to fix and flip it, rent it, Airbnb it, or do a seller finance scenario. And you start to generate wealth through these types of transactions where you're generating hopefully equity and mainly in today's marketplace, of course, that cash flow. And guys, do the quick math in your head. You don't have to go out there and do 10 deals a month. It'd be great if you could. Imagine if you're able to do just 1 deal a month. Imagine if that one deal makes you $1,000 per month positive cash flow. So imagine if you do that over the course of a year, you now have 12 deals paying you $12,000 a month of income. Sure, you got to manage the collections and those kind of things along the way. You got to stay on top of it like anything else. That's a big chunk of change. The fun part of this business is realizing if you do 2 a month, 3 a month, or you do it year 1, year 2, year 3, easy to do the math on how rapidly this can grow to some awesome positive cash flow along the way. And I'm not going to take the time to go through any more issues here in properties just because I want to get to your questions as well pretty quickly. But what I wanted to do initially for you guys is just to say, first off, thank you for attending this. This is really an all-day seminar. Sometimes it's a 2-day seminar to really get more into the nitty-gritty of the subject to business. We want you to really start off your game in 2025 and consider signing up for our subject to mastery course. My partner Susan and I broke this out from our overall owner financing perspectives, which that course is available online. The sub 2 course is available, which is all things subject to help you as the investor truly understand sub 2 from somebody who is both a real estate investor who has done to date something north of 7,500 real estate transactions personally, whose law firm has closed over 10,000 deals from the creative finance perspective. That is all things subject to wraparound, executory contract, etc. And all that means is it gives us a lot of knowledge to bring to you, the investor, a knowledge base, both from the real life practical perspective, because we go out and beat the streets every day of the week, to the legal side as well, and what to think through in your transaction. Now, you're going to get a coupon code if you click on the QR code here or follow the link below. You get that $100 off. And I think that puts it in at $199 for the course. And additionally, if you all want a copy of this presentation, just email us at info@theownerfinancenetwork.com. And we'll be happy to send you a copy of this presentation as well. If you also take a moment, guys, and visit that website of theownerfinancenetwork.com, you will find tons of free videos, Ask the Attorney, everything owner financing on our YouTube video channel as well. I think we have about 750 videos on our YouTube channel right now, which are all things owner financing, from finding the property to selling the property to analyzing the transaction, the talking to sellers, contracting, the middle part of the deal, the closing, the back end navigation, everything you need to know about the creative finance world to help you be successful. And this is an industry and a business, guys, that works in all states. I want to point out one last thing as we close and I go to any questions, is that you need to make sure you check with your state about foreclosure rescue laws. Some states, I think there's like 20 or 21 states that have some form of this right now, from a 3-day right of decision to maybe even a 30-day right of decision or other things of this nature that you really need to follow. It's important because there are some penalties if you don't. And of course, if your seller is in that pre-foreclosure mechanism, make sure you have checked on those things and you know what those are in the state where you're doing business. One of the good things is here in Texas, we don't have that. In Arizona, where we do a lot of business, it doesn't exist either. But make certain you are addressing those things in your state. And as we go through this, we get back here. This last screen just kind of tells you a little bit about who we are and what we do, which hopefully gives you guys a knowledge base that we're here to help you out in this industry. We absolutely love the seller finance industry, whether it's from closing a deal here in the Texas marketplace through Horne and Associates PC. We are OFN National Escrow. So if you are closing a transaction in any other state out there, we can help you close these transactions, whether that is with or without title insurance. We provide closings throughout Texas nationally with title insurance as well. Here in Texas, we are First Option Title. We are First Option Title AZ in Arizona. We're located out there in Scottsdale. We're Horne and Associates, and we help provide you everything you need to be vertically integrated into this creative finance business, from legal perspectives, title, from loan processing, if you're going to do a wraparound mortgage to a back-end consumer, to loan servicing, all things in the Texas marketplace as well. So with that, I want to again say thank you to everybody who has joined. And I'm going to try to find the screen and how I find out how I answer any questions that might be out there. So as I go on, just look at this. One of the, let's see here. I'm just scrolling through our chat question, guys. Give me a moment. Lots of good morning. Van got a birthday present, so happy birthday, Van. Going through this again. Sam says hello, Susie.
Oh. Hi,
Um,
Sam.
So what is the best place to find capital for second lien positions, such as reinstatement? And guys, in the real estate investment world, learning how to find capital is so important. Your hard money lenders, your banks, they're not going to provide you, lending for this purpose out there. If you're part of the sub-2 community, as we call that, with Pace Morby, they try to teach a lot of people how to do gator lending and whatnot. You got to be very cautious about that for some various reasons. But private capital for me started at home, where I went out and it was actually my family were my very first lenders. And it started small and slowly built up. But I think we all know that there are people who want to be in the real estate investment industry, but they are scared to be in it. Everybody knows somebody who's a landlord, and they're also wanting to get out of being a landlord. But tons of people want to be in the business. They're just scared to pull that trigger. And the best way, of course, to find money is just to open your mouth and talk to people within whatever your sphere of influence is. At the job where you're located, your friends, your family, church, whatever it might be. Go to real estate investment meetups and groups wherever you might be. Let people know what it is you do if they know anybody that lends money. And sometimes, you might have to start off paying a little bit higher interest rate than you would when you get more and more experience, just because there could be more risk to that investor along the way. When I got started, I was paying 18% for my money. And over the years, I brought that down to 6 to 8%. But it just really is a matter of going out and just telling people what you do, and you will be amazed at how many people really want to be in that industry. So capital gains on an owner finance deal. So I believe that any net down payment that we receive would be taxed as a short-term cap gain. And of course, any positive cash flow from an interest perspective will be taxed as the standard ordinary gain. Now, if you have bought the property, maybe you leased it for a year before you did something else with it, you may be able to capture long-term capital gains on that property. Typically, there's not going to be an issue with becoming what we call a dealer. And a dealer means where all you do is seller financing and carry back paper. in the sub two world, you're not going to be dealing with too much issues of cap gains, but the income you receive on that property, the net income, is going to be taxed, I believe, as ordinary income along the way. Is it possible to do a sub two in a home that has a reverse mortgage? Absolutely. And with that, you know, what you have to understand about a reverse mortgage, guys, is a reverse mortgage comes due 12 months after the last of the spouses that lived at the property either move out or they have passed away. Now, too many people notify their lender immediately of this, which you're not required to do. But we buy homes subject to reverse mortgages. And when you go into it, it's just realizing you're going to have to find a way, most likely in about 12 months, to refinance that mortgage. Now, if you got into that property and you started making payments to a reverse mortgage company, to a reverse mortgage company, would they slow that process down? Maybe. Of course, at the end of the day, all these mortgage companies, they just want to get their money back. And if payments are being made to them, they may not call that loan due. But you want to go into it with a situation where you know that you've got to get that first lien mortgage paid off within that prescribed time frame. And let's see here. Rob says it's his birthday too, so happy birthday, Rob. Let's see what else we got for y'all. So selling a property with a wraparound loan, a contract for deed, things of that nature, and owner financing a deal that has a HELOC. So I'm going to start with the HELOC question, guys. If there is an existing home equity line of credit on the property, we won't close that deal unless and until the HELOC has been closed out, which the seller can do by simply going to the bank, terminating it, and locking it in, where most likely there is some type of a loan mod created for that, and they start to amortize that loan. So you don't ever want to close the deal subject to and leave an open home equity line of credit out there, because could a seller go out and borrow more money? They could, and believe it or not, we have seen that happen before. Here at with myself and my partner Susan, we do a very large amount of wraparound mortgages. That is a whole different animal in conversation. And as you guys visit the ownerfinancenetwork.com website, we have a great lien presentation on there that teaches about all things liens that can affect our real property and how to navigate those. Again, it's pretty accurate for all states, but you always want to talk with a knowledgeable attorney in your state about those items as well. But knowledge is power in this industry. And we also have a program for wraparound mortgages. It's actually the entire owner finance program walking through that. And we can have another day to talk about wraparound mortgages in addition to the subject to world out there that we'll try to push out into the marketplace. And then a contract for deeds can be utilized in most states. These are executory contracts. In Arizona, they're called agreement for sales, other states land contracts. Here in Texas, you gotta be very careful because our property code has some major issues regarding the sale of a property to a owner occupant, a consumer, with a contract for deed. So Texas is not a good state for that, but other states may be. And there's a lot of issues that come up regarding selling a home with owner financing to a consumer with a contract for deed, because the key really is what is your back end goal? Is it to have them eventually pay you off? And if it is, there are probably better ways of doing that with a wraparound mortgage versus the contract for deed. Again, that's a topic for a whole nother day as well.
More questions.
So interest carry. What does it mean to carry interest? It means when you buy a property subject to the existing debt, every month you've got to make a monthly payment. then we buy a home subject to, you're paying principal, interest, taxes, and insurance, and we call that carry. It's not just interest carry, but it's going to be PITI, the whole thing. You got to make sure you have those dollars available until such time as you get your property income producing. Another question is there a specific hedge fund or a lender that can help on rehab of sub two? Well, again, I think I just mentioned that about how you find private capital for a sub two. I don't know any particular hard money lender. They're usually first lien lenders. I will tell you here at Goat Funding, we would consider lending second lien capital on sub two deals based on the transaction, based on the borrower, based on the dollar amount and its location from a control perspective, but it's not a primary source of business. Finding money for the rehab and the carry cost of your sub two transaction is usually in the private world, where you going out and borrowing money from a lender through a line of credit of some type that you might be able to utilize for that purpose. A contract for deed. A contract for deed is called an executory contract, which is something to be performed in the future. A contract for sale is actually an executory contract, but in the context, I think what Karen is asking here, a contract for deed is where you sell a home to a borrower using the executory contract or contract for deed. And when the borrower fulfills the terms of that contract, which might mean they agree to pay you, for instance, $1,000 a month for 100 payments, then you do something in the future, which is you give them the deed to the property. And usually a contract for deed is a little bit easier to terminate than a wraparound mortgage is, because it is a contract and not a mortgage. But have a great explanation of that on our OFN YouTube channel that you can check out as well. It goes into more detail on that for you. So Sean has a question about, do we have any best practices or quick rules of thumb that we use when purchasing sub two deals? My first answer is no, because every deal is so different and every seller is so different. And what I'm looking at when I look at a sub two deal is first and foremost the location of the property, the quality, and what is going to be my entry cost to get into that deal. What do I need to pay the seller to reinstate the loan? Do they have a lot of equity or need equity or something like that? Are there any realtor fees, repair fees? And then I'm going to build in 6 months of payments into that dollar amount needed to close a deal. And guys, I say that because one of the things that you'll find in the marketplace is that historically, most houses, when they go on the market, sell between 4 to 6 months, maybe 7 months. These days of houses selling in 1 or 2 days are gone for all intensive purposes out there. So the first thing I look at is what's going to be my cost of entry. And in the particular neighborhood where I'm located, what is my back end strategy? Is it some type of a rental, Airbnb, or is it seller financing? For me, since we do pretty much seller financing only, wraparound mortgages on the back end, I'm looking at what the prospects are for selling that home, the marketplace, my demographics, who's going to be my prospective buyer out there, and then what can I sell this home for, and what will my cash flow be? Because I want to know, if I know what my front end requirements are for that amount of cash I need to close, the question then becomes, what do I reasonably think I can get on the back end on a net basis? What's my cash flow I can apply back to my private lender? And how long will it take me to pay them off? 12 months, 24 months, 48 months, something else? And am I willing for that property in that location at this particular time, willing to do that? And if you are, pull the trigger and go. Joe is asking, who's our go-to insurance provider? So again, we found a great insurance company. You can also find a YouTube video on insurance on our OFN National YouTube channel, where I sat down with Randall of Sergeant 55, who's here in the DFW area. Excellent insurance company. They're not only insurance agents, they are investors themselves. They understand stuff too. They understand wraparound mortgages and things of that nature that are out there. And we love to make them a referral source for us because they have a pretty intricate understanding of our industry that is all important. And Miss Vanna, I'll call her Susan, actually. I call her many names, but I'm calling her Vanna because she's providing me all these little notes along the way. If you care to reach out to Sergeant 55, you can reach them at 469-222-1969. So guys, I hope you found this at least briefly informative. If you really want to get more in depth into the subject to world, and another question has popped up and I'll come back and address that. But taking a minute and considering purchasing the sub 2 program we have, the sub 2 mastery program, we really try to put into it real life information to help you be successful at the subject to world. Everything from locating properties, sourcing them, talking to your sellers, what is the information you need to know upfront before you go in, meeting the property, determining what money you need along the way, navigating the contract and the closing process, the back end process, the things that you need to know to be successful at the subject to world. And again, this is all we do in our businesses here. If y'all don't know that, is we are 100% in the creative finance world in our law firm. Our title companies are investor geared almost exclusively throughout Texas and nationally. And we'd love to have you guys come see us and talk to us about this and how we can help y'all along the way. Luis asked the questions about hard money lending for owner finance transaction. Is it more difficult to get a hard money loan? And really, the problem with hard money and owner financing is you can use hard money to buy the home and renovate it, but most hard money lenders are short-term lenders, 6 months, 9 months, maybe a year. And they expect you to have that house purchased, renovated along the way so that you can then refinance it either the mortgage company or through a DSCR loan. And again, if you want to reach out to us, we can certainly refer you to several DSCR lenders that might be able to help you get that refinance done. And for those who don't know what a DSCR loan is, that is a debt service credit ratio, where they're basically looking not at your credit, but they're looking at the property, its value, where they'll lend somewhere between 70 and 80% of that value based upon the legitimate, verifiable potential income that property can produce. For instance, they basically look at what is the rental rate for that property. They're going to want to see most likely a 1.2 debt to income ratio that's out there. So you can use hard money, but you need to go into it with the anticipation you needed to refinance out of that before you do a back end seller finance transaction. And Sean, thanks for the go-to there on closings at our offices. Again, this is what we try to do, is help our investor community truly be successful, in this business out there. I think I just answered that insurance question along the way as well. So in selling a course of the wraparound mortgage, right now on our OFN website, it is the owner finance program, which is about an 8 or 9 hour course, which talks about everything. The problem with that course is it was done several years ago. And in the format that we filmed it, it might be a little bit harder to watch. It just, you need to watch it in segments, just because it's long. And you're listening to us talk at you for 8 or 9 or 10 hours along the way. We're in the process of gearing up to film the wraparound version of owner financing as well. We can talk more direct about that back end scenario. Uh-oh. So when you guys click on the QR code, what I'm getting from everybody is that there's no space and no $ in the coupon code, just $100 off. And I think that was put into the chat scenario out here as an answer along the way that you can find as well. But if you have a problem with that, you need help, you can always reach out to us at info@theownerfinancenetwork.com, and we can see to you can get that as well. And again, as I talk about this to all those who are online right now, we're not here to sell you guys a $5,000, $10,000, $20,000 program in some format. What we try to do is truly give you information that will help you be successful, both through inexpensive programs like the Subject to Mastery course, as well as our YouTube channel, where we give you as best information we possibly can to help our investment community be as successful as possible. We love this industry. Again, this is all we do. I want to give a shout out to Andrea Langston again, who is on this. She is our lead closer at the Owner Finance, not the Owner Finance Network, at OFN National Escrow Services.com. And she is located out of Arizona in Scottsdale. If you visit the Owner Finance Network, you'll find a direct link over to her as well. So guys, thank you all again for attending on this Saturday morning, leading off into 2025. I really wish we could have done all this in person. It's a lot more fun to get some direct feedback along the way also, and be able to answer more questions and help navigate. Hopefully we'll do that here soon. But again, thank you guys for attending. I look forward to talking to you guys on future transactions and helping you along the way and whatever your industry might be and how we can help you get deals done. Have a great rest of your Saturday. You all have a great day, guys. Bye-bye.